Yes, what's up, everyone? 360 in the house. We are doing another chapter on the 360 Elite Trading course, and this one is about wedge trading, wedge trades, wedges. What are wedges? So, hopefully, after you've taken those other classes on lessons that we had on flags and pennants, now getting this wedge in here, you'll be able to distinguish the linguistic difference, the semantic difference between them, because there are differences. You know, you'll have people calling pennants wedges and calling wedges pennants and calling pennants flags and this, that, and the other. But you guys having had this course, you know, you are going to know the semantic difference, the technical difference, and ultimately, you know, as long as you know how to make the trade when you see the pattern, you know, it doesn't really matter what you call it. Let's just be honest. But, you know, there is a right and there is a wrong, and I want to make sure you know the right. So let's get into it. Wedge trading. You'll see wedges quite often. It's a pattern that you'll see quite often, besides the flag, which is one of the ones you see probably the most, and the pennant. The wedge is still a pattern that you see a little less often than that, but you still do see it. So what is the main difference here on this pattern is that for a wedge, both the support and the resistance lines, both of them must be going at an angle, and they're going kind of in the same direction. So none of these will actually be straight across. You know, a lot of people see a straight line and then one angled, and because it looks like what we would consider a wedge, they call it a wedge, but that's not the case. Both lines, support and resistance, must be traveling in the same direction. That means either both upwards or both downwards, and then usually they come towards an apex or a center point where you have a squeezing of price, whether that be with this rising wedge here, you have resistance going up, you have support also going up, but you have price action squeezing between them as they merge towards the apex of the wedge. And then down here you can see price action coming into the falling wedge and price action squeezing again with the resistance at the top and the support at the bottom. And you can see the price ricocheting back and forth as it gets shorter and smaller and tighter and tighter. You get that squeeze, that price action pinch. You get that pinching of price action, that squeezing. And that kind of will let you know, that alerts you that the steam of that movement, you know, it starts out big. The steam of that movement is starting to die down. So if the wedge is going upwards, as you see here, and the steam is dying down as it's going up, what is it going to do? It's gonna go the other way. So we're traveling upwards here in this rising wedge, but you can see that the resistance or the buying is not going quite as high. We are getting higher highs, but the lows are getting higher as well. And the price action volatility is starting to pinch. It's starting to pinch, showing that momentum move, that movement in the upward direction is starting to die down. And sure enough, boom, you get that. For this instance, as a continuation, you have a downtrend. Downtrend, and you have a rising wedge. When you see rising wedge, you should immediately think bearish. When you see falling wedge, a falling wedge, whether it's continuation or reversal, you should immediately think bullish. And in this certain setup right here, we have the rising wedge. We have as a continuation pattern. So for a continuation, we have the downtrend. We have the rising wedge. Price action starts to die. Since it's a continuation trend, where is it going? It's heading back down. So you get your breakout move right there. And you resume the trend. Now, if we have the uptrend on the falling wedge, now we have the falling wedge, means price. The sellers are stepping in, but that selling is starting to die down. It's starting to pinch. And then sure enough, the ultimate trend, the prior trend resumes or continues. So you have the uptrend, you have this little sell-off, but that action starts to die and falter and squeeze and pinch. And then boom, you have your breakout. These are continuation setups. Now let's look at the rising wedge and the falling wedge as reversal patterns. So this time, remember, like I said, if you have a rising wedge, it's always bearish. You're considered bearish. Falling wedge is always bullish. And whether it's continuation or reversal, that depends on where price is coming into that wedge. Here, we have an uptrend. But it's going into a rising wedge. So we're moving up at a nice rate of speed, right? But what's happening to the price action? It's starting to die down, like it's starting to become less and less volatile, less and less sure as that price begins to pinch. Buyers and sellers are starting to agree, and it's starting to pinch. And then sure enough, off this rising wedge, you have it as a reversal, and price actually does come back down out of that. Let's look at the falling wedge. So here we have the downtrend. Remember, these are reversal setups. So here we have the downtrend. So for a reversal of the downtrend, you're looking for a falling wedge. So the price is continuing to go down, only it's forming this squeeze here. You have resistance and support starting to squeeze together, and you can see that the selling action is beginning to falter. It's beginning to die out. It's beginning to lose steam. And then boom, you have the reversal. You have that reversal breakout come out right on top of that. Very simple, very easy. There are a few things you need to understand about the trading, though, that makes it different from pennants and flags and so on and so forth. So remember, wedges can be continuations or they can be reversals. Know that rising wedges are bearish. Falling wedges are bullish. If you know that and you see that wedge in the price and the trend that it's in, you will know whether it's bearish or bullish. Boom! Love it. Let us continue. All right, let's go over some general rules. I don't know why I didn't put a photo over there for you to look at because this is kind of boring right here. So wedge general rules, both lines will go up or downwards. Like I said, you'll see a lot of people calling pennants, especially when it has a flat line. You know, you'll see a flat, it looks like a door stopper. You know, we call those wedges. Well, not in this case. You know, both lines will be going upwards or both lines will be going downwards into an ascending wedge or a descending wedge. And they will come towards an apex. They don't have to necessarily pinch to a perfect point. Let me just make that clear. These wedges don't have to come to a perfect point. As long as those lines are squeezing towards each other, as long as the resistance and the support are squeezing towards each other, and the price action is pinching, they don't have to pinch all the way to a point. Doesn't have to do that. Doesn't have to be that way. All right, so it can be a rising wedge or a falling wedge. We got to see that in picture pattern format. And again, rising wedge is bearish. Make note of that. And falling wedge is bullish. It doesn't matter. That right there is going to be your indicator. If you know that, then no matter how price is coming into that wedge, you're going to know how it's going to come out. That's how it works. Now, here's a cool little thing that a lot of people don't know. The steeper that wedge is, the more reliable the signal. You're going to see some that almost kind of go sideways horizontally. And they can still wedge, but man, they come really close sometimes to looking like pennants. And sometimes you just don't know. And so the best thing to do is place your trading rules. And if the trading rules, you know, you're playing the breakout and the trading rules, just play the rules that you have. So, but the steeper the wedge, you know, the more angled up or the more angled down it is, man, the more reliable that signal can be for you. The breakout. So the other thing is when you go into the wedge, I didn't write this in here, but I need you to write this down. When they go into those wedges, when price is trending, but it enters one of those wedges, whether it's ascending or descending, you want to generally see volume start to drop. It shows that fading as that price pinches towards the apex. It shows that fading of passion and power and FOMO and trending it's just not there. But on the breakout, just like all the rest of the other ones, pennants and flags, you want that breakout to be on strong volume. Yes, that's what we want, strong volume on the breakout. Now the target, there's no pull. It's going to look like you have a flag pull, okay? You can have a flag pull. That's not how these work, okay? That's not how these work. You don't base the target off of a flagpole in a wedge. You base your target, your estimated target is based on the distance between the highest area of resistance and the lowest area of support of the wedge. And we'll look at that by means of a picture in a minute. So those are some wedge general rules. So this is a pretty crappy wedge, but you can see price action is pinching. It is pinching, and a lot of times it's a lot more dramatic than this, but this just gives you an example. So for the rising wedge, there are two cases when you can open up a down order, all right, or go short when you want to go short on a rising wedge. The first one is you're in a downtrend already. So you're trending downwards. That's what we have right here. And then we start to ping pong back and forth. And we have a rising wedge. Remember, rising wedges are what? Bearish. Bearish. So as we see this wedge develop, price action starts to pinch towards a point. We are going to begin to watch this for a trade. And on this case, we want to go short because we have a downtrend, rising wedge. So we know this is a continuation pattern. So where would you want to enter this? You want to wait for this area, the support level of the wedge, to break. So you'd want to enter on a breakout here. You'd want to enter on a breakout of that lower support area. So where would you want to put your stop loss? You want to find the highest level of resistance in the wedge. In this case, it's this price point right here. And you want to draw your horizontal line. You want to put your stop behind that. So if I'm entering down here, this is my highest price point. Draw my line across. I'm going to put my stop loss right up in this area right here. Right up in this area. Now, your target. Remember your target. We're not measuring a pull. We're not measuring a flag pull. Instead, you're measuring the distance, the largest, the maximum distance. So you go to because this could be much wider. It could be narrower, but you want to measure it at the widest point. So the highest point of the resistance to the lowest point of the support. Then you want to take that measurement. You want to place it at the breakout point, and you want to draw it equal to this distance, should be equal to this distance. And that is your target. So again, you do not measure flag poles on wedges. You measure the widest wedge gap area, the widest point of the wedge, and then you apply that to the breakout, and that is your target. All right, so that's one case where you can open up a short on a downtrend with a continuation rising wedge. The second case when you want to go short is on a reversal wedge. So the rising wedge is a reversal when you have an uptrend coming into it. So we've got an uptrend coming into this wedge, but it's rising. And that tells you that that trend or that rise or that momentum is starting to die down. Why? Because price action is beginning to squeeze towards itself. So here you got this nice bullish uptrend. I know you can't see it, but you can imagine it. And then boom, it starts to ping pong and it starts to squeeze towards an apex. So now you are looking for what? A breakout of the support for your entry. And then your stop loss, you go to the high point. This is the high of the wedge, the high price action of the wedge. And you'd want to place your stop behind that somewhere. Behind that somewhere. Depending on how much the price difference is, sometimes I place it behind the actual resistance part of the wedge. And then to measure, again, you go to the widest gap, the widest section, the widest measurable section of your wedge from resistance to support. place that at the breakout, and that will give you your actual target. Man, it's so simple. This is so simple. So simple. All right, let's go to the falling wedge. So the falling wedge, you can play in the upside. Remember, falling wedge is what? It's bullish. The falling wedge is bullish. So let's look at the first instance. In an uptrend, a falling wedge is a continuation pattern. This is the uptrend. Woo! Uptrend, 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 uptrend. Falling wedge shows you that it's a continuation pattern. Why? Price action comes in, you get some profit taking, but that profit taking starts to die down into an apex. It starts to get squeezed. Hopefully you have lower reduced volume during this until boom, you have your breakout. You enter on the breakout. Enter on the breakout right here. You measure from here to here is your distance. And that gives your measurement, and that is your profit distance. That's how you measure your target. So we have our widest point from here to the low. From here is the high. This is the high of the wedge. This is the widest part of the gap that you'll measure to. It's not here because this is where it entered. So it's here. You measure that distance, that gives you your target, your estimated target right there. And then you find the low of the price action in the wedge, which is right here, and you place your stop right below that. Man, that's so easy. So easy, so easy. That's the falling wedge. Let's look at the second time you can play on the upside on the falling wedge. This would be the reversal. So now we have a downtrend. We have a downtrend into a falling wedge. Price action starts to squeeze, starts to get pinched towards an apex, showing you that that downtrend is losing momentum. It's losing direction. It's starting to fade. And hopefully you get a reduction in volume here. Very simple. You want to go long on the breakout. Go long on the breakout. You're measuring the distance. Right here is your measured distance because that's your highest point. And this is the widest point of your wedge. The widest point of your wedge. So you're measuring that point right there. And you throw it in here on this side where the breakout is, and that gives your profit, your estimated target for profit. And where's your low? Your lowest area of price action inside that wedge. That is where you want to place your stop below that. Remember, don't put it at it. You want to put it right below that in case this fails, comes back and tests it before heading off. So very simple. That's the falling wedge as a reversal in going long. Very easy, very easy, very easy. Again, measuring that target. I want to show this to you again. So it would be here to here, right in here. Here's the high. I would measure to about right here. I actually have this. I would measure it to right here. Some just stop right there. I would measure it to this point right here. I would take that, move that to the breakout, and that's how you find your target. So you have your resistance, you have your support. Your resistance, your support. You have an uptrend going in to a descending wedge, which is bullish. Price action starts to come to an apex. You have your breakout, and then you have your target based on the distance, the widest part of the back end of the wedge. Man, so easy, so easy. No flagpoles with wedges. You're going to look at it, and it's going to be sitting on a flagpole. You're going to be trying to measure the flagpole. It's not the same. So wedge entry risks are just like the other ones. You can enter upon the breakout, but know that many times it comes back to retest the breakout point. You must know this. As a trader, you must know that. That's on almost every type of breakout. I don't care whether it's a simple horizontal breakout, a flag breakout, a pennant breakout, a wedge breakout. It happens often. So know that if you enter the breakout, you may have to sit tight, let it come back and retest before it resumes. Or you could wait for the retest of the breakout, but you could risk missing the trade altogether. Or you could enter at the support of the wedge. That means before it breaks out, before it makes its move, because you already know whether it's descending or ascending, and what the trend was prior to. You already can predict which way it's going to go for breakout. But you have to know that if it fails, you could get stopped out. That is your wedge entry risks. Man, that was literally way too easy. Way too easy. Boom! That was wedges, baby. They are tradable. They are good patterns and very reliable. I find them to be very, very reliable. All right, y'all. Hope you liked the class. Kept it short. Until next time, here comes the boom, baby.